Hi, everybody. Welcome to another Money Monday live training. This is a little bit of an impromptu training today. I didn't have time to put together a full-fledged training like I usually do. I had to take care of my eyes today, getting some new glasses, and I had to get some things straightened out with the eye doctor. So I hope that you find this training interesting and helpful. As always, I love to have you leave some comments if you're here today, or if you listen to this training after it's posted. Please put a 1 in the comments or a thumbs up or something if you enjoyed the content, so that I know that I'm on track with what you're interested in. So today's training is a PowerPoint presentation that I borrowed from one of our coaches that's in my mastermind group. Many of you know that I belong to a TradFi DeFi mastermind group. It's all about trading cryptos, trading in the stock market, and it's about yield farming. I've been in there for about a year now. There's multi-million dollar people in there. There's even some billionaires that are part of the group. And this training was given to us by one of our coaches. Like I said, his name is Zach. And he gave us an overview of where he sees things going in 2023. Now, I unfortunately did not even get to attend this particular training, so I borrowed the slideshow, and I've deleted several of them that I couldn't really make sense of because I didn't get to hear the original training. But I think there's enough good content in this for all of us to get something out of it. So with that, I'm going to go ahead and get started. And if anybody joins me live, I'd love to know if you're here. Just leave me a comment. Okay, so the next slide here. There we go. So he said in this slide, expectation setting, and I don't really know what he meant in this slide, so I'm going to go on to the next one. And I do know that the intention with this little presentation was to cover the macro picture, macroeconomic picture of what's going on in the world. The TradFi just means the stock market, trading in the stock market, and then the crypto markets. So I'm going to do my best to cover each of those just a little bit in this training using these slides that I got from Zach. So in this slide, it says the 2023 baseline. So we have 5 categories here: growth, recession, inflation, interest rate, and the stock market. And here's what he has to say. For growth, it says 2023 may be one of the slowest years for global growth in decades. And this is coming from the IMF, the International Monetary Fund growth projections. Number 2 is recession. It says recession and political risk in Europe and the UK economics is going to be pretty intense still. This information is coming from BlackRock Geopolitical Conflict Risk Chart. We'll see some more of that later on. I know there's a chart about that. The third one is inflation. Inflation will slowly fall, he believes, to 4.6%. And actually, this information is coming from the FOMC. And this is their PCE inflation, which is slightly different from the CPI, which we'll also see in a little bit what CPI is. The fourth one is interest rate. It says central banks will remain restrictive. So there are rate hikes that are expected to go to 5%, and unemployment is expected to go to 4.6%. And there's also a chart that will explain that a little bit too coming up. And the fifth one is the stock market. It says U.S. stocks tend to bottom at 33 to 37% below peak in times of recession, which suggests a fair value of about 3,200 for the S&P in the first half of 2023. So let's see if we get to that. I don't know where the S&P is at right now. If somebody's listening, if they know, please put it in the comments. Okay, the next slide is the World Economic Outlook update. And this was presented by, as I said earlier, by the IMF and the World Economic Outlook update report that they did. This was done, this was last updated July 2022. And if you can see, it shows that in the United States, our growth rate from 2021 down to 2022 and into 2023 has gone from 5.7 down to 2.3, cut in half, and then cut in half again down to 1.0. And what this says is our expected projected growth rate is going downhill. We want it to be going uphill if our economy is doing better. And when the economy is doing better, people buy crypto. When the economy is not doing good, people, especially the retail market, tends to not buy crypto because crypto is a high-risk asset. And money managers tend to not put money into crypto when the risk is off the table, so to speak. And so if we look at Europe, it's the second worst of these three, of all these charts. And it started at 5.1, dropped to 2.6, again cut in half, and then cut in half again down to 1.2. So not looking so good for Europe either. And the next worst looking chart on here is for Latin America and the Caribbean. And again, these are numbers from 2021, 22, and then 23. And I'm not sure what it's percent change. So these numbers are percentages. And it looks to me like the area that's doing the best is sub-Saharan Africa, if you can believe that. I find that quite interesting. And then the next one that seems to be doing not so bad is emerging and developing Asia. And then the next one that's doing not as bad as the other three is the Middle East and Central Asia. And I find that in crypto markets especially, that Asia is often leading the way. So sometimes it pays to notice what's going on in those parts of the world when you're interested in what's going on in crypto. Okay, the next slide, let's see if I can make sense of this one. It says a workforce not recovered. So it says the chart takeaway is the labor force participation rate fell dramatically in the pandemic as the economy shut down. And many people who left the workforce haven't come back and won't. And this again is information from BlackRock Investment Institute. It also looks like data was taken from the U.S. Bureau of Labor and Statistics. So this says the aging populations are negative for economic growth. Production capacity will grow less quickly in the future as an ever larger share of the population is past retirement age and not working. All this leads to macro environment, especially in the U.S., is downhill. And basically, we're not growing. Okay, let's look at the next slide. Geopolitical risk grabs market attention. So what I think Zach is saying in this chart is it starts out at 2018 and ends into 2023. And in the middle of the chart there is when COVID hit. It says WHO declares COVID-19 a global pandemic. That was around 2019, 2020. And the risk shot up from 2018. It was negative 0.5, and then risk shot up to a positive almost 1. And these, I don't really know what the numbers mean, but I don't think it matters. This is relative. So what's relative in this chart is the very end here. If you can see what I'm circling, I don't know if my mouse is showing on your screen. It might not be. So to the far right of this chart, you'll see how the risk has just spiked big time. This is global geopolitical risk. And it spiked up before the far end here, about looks like 2022, the Russia invasion of Ukraine. Big risk shot up there. That really stalled the markets. And now we have more risk. And I'm not exactly sure what he was thinking was causing this risk at the end. A continuation perhaps of the Russia-Ukraine war. I'm not sure. But let's see what his comments are. We have seen a surge in market interest in geopolitical risk in recent months, highlighting how fraught the current environment is. So he's basically saying there's still lots of geopolitical risk, which is putting pressures on markets, which is keeping them down. Although right now we're having this little bull run kick up thing, so to speak, and I'm going to talk a little bit more about that before this training is over. Okay, so this says, does inflation come down with a recession? And this chart shows history says yes, big time. So I'm not going to look at all those tiny little numbers, but what it's telling us is that when economies have a recession, inflation goes down, and we need inflation to go down. Inflation is out of control right now. I don't know about you, but when I go to the grocery store, I cannot believe how much it's costing me just to buy food and then gas. And for those of you who don't know, this is based on the CPI numbers, and CPI stands for the Consumer Price Index, which is a measurement of inflation. And it very much measures consumer products. I believe it takes out industrial type things. It might actually take gasoline out of the number. I know it includes whatever I just said, because I just looked this up. It includes things that affect us on a day-to-day basis. What does it say at the bottom here? Nothing helpful there. So we want, in some ways, we kind of want a recession, although it might look kind of messy if we had one. But if there was a recession, it would bring inflation down according to history. Okay, so in this chart, I find this chart quite interesting because this is talking about the Fed rate hikes. So the dark blue boxes here are the rate hikes that have already happened. And these are all the biggest rate hikes. It started out at a quarter, 25 basis points, which is 1/4%, 50 basis points, 0.5%, 3/4%, 3/4, 3/4, 3/4. Those are big jumps. And that puts us to where we are now, which is about 3.5 to 4% in a rate hike. And now these hashed lines up here that are light blue and dark blue, this is where the FOMC, or where the Fed funds rate is expected to go. And this is throughout this is just through May, maybe June of 2023. So as you can see in the picture here, these boxes get smaller and smaller. This is, we start out with, in December, there was 0.5 basis point that was expected, then about another 0.5 basis point, then 1/4, then a 1/3, then 1/4, then even less and less. So I know that Zach is very bearish on the markets through like June of this year. Even though we're having a little pump right now, he's expecting the markets to come back down because these Fed funds rate hikes are not done, and they won't be done, I believe, until about June, which is what this is saying. And that would put us at about a 5 to 5.25% Fed fund rate by the end of all these hikes. Okay, I hope that helped and made some sense. Let's go on to the next slide. Where am I here? Okay, down here. So that was the end of looking at the macro picture, just taking a few of his slides and trying to see what he has to say about the macro picture. Let's go on now to looking at TradFi. So I thought this was another interesting chart. This is the path of the S&P 500, a soft landing versus a hard landing. So the S&P 500 falls to 3,600 in a soft landing, but it falls down to 3,150 if there's a hard landing, if investors price in a hard landing. Now, I don't follow the stock market as much as Zach does. I used to, but I'm totally into crypto now. So I don't trade the stock market. But it pays to pay somewhat attention to where the markets are going in the stock market, like the S&P 500, maybe even the VIX, if you all know what that is. Because, you know, if the stock market is doing really bad, there's a good chance that crypto is not doing much better. Those haven't yet diverged. I'm looking for the day when the stock markets and the crypto markets go their own direction. They completely diverge, which means that if the stock market is going down, crypto markets aren't necessarily going down. But right now, they do sort of follow each other. So in this chart, it shows that if there's a soft landing, then in 2023, we would end up hitting down around where it said 3,600 would be a soft landing. And then the chart shows that it would come back up into 2024. It would come back up to 4,000. So we would end up bottoming right around 3,600, and then we would be back on the upswing. So that's why a lot of people believe that the big bull run market for Bitcoin isn't going to happen until about 2024. And if Bitcoin goes on its bull run, which I believe will happen at the next halving, cryptos, all the altcoins will follow. So if we don't have a soft landing, if we have a hard landing, then we could fall all the way down to around 3,150 by mid-year 2023, which means there's more downward pressure, which is why a lot of the people in my group, in my mastermind group, believe that this bull run, that we're little mini bull run, I'll call it, we're having right now is temporary, that it's not going to last. But you know what? You can still make money on it. I've already made some money on this little bull run. I had a couple of tokens that I bought, prior to this little bull run, and I sold them so far during the bull run. So I made 36 and 40% on the two tokens that I sold. So I'm happy with that. Why not? It doesn't have to be the big bull run. If you're comfortable enough doing a little bit of short-term trading, then this is the kind of market you want to do that in. So anyway, the hard landing, if it happens, they're saying mid-year it could drop all the way down to 31.50, and it wouldn't by the end of the year 2023, it would only be back up to 37.50, not nearly as good as if we were to have a soft landing. So all we can do is watch and see what happens, see which one of these potential landings happens. There's another chart coming up in the next slide. I also found this, just the image on the right-hand side. I found this very, very interesting. So this was put out by Goldman Sachs, I believe. And this chart on the right is showing potential scenarios that was run after numbers were run through some AI software. So this is not done by people, wasn't done by analysts. This was done by AI computers. And this is what they came up with. So the baseline is the blue line. I don't think my mouse is showing up on your screen, but if not, that's okay. I'll just call them by the colors that they are. So this blue line is the baseline for the S&P 500. So this is what is anticipated if nothing major happens for housing, inflation, that sort of thing. If we just have a normal market movement with what's going on, this AI software thinks that this is what will happen. That right now we're right around, I don't know, it looks like around 3,700, somewhere around in there. And that we will drop all the way down to this 3150 roughly looking mark. So this model makes it look like the hard landing is more likely. And it looks like the bottom hits right around July of 2023 in the baseline. And then it starts going back up in a V, which means it's going back up quickly. And by January 2024, we're back up to almost 4,000. So that is the baseline of what the AI says could happen. Now, what if there was a housing downturn? What if the housing market were to fall out, the floor were to fall out, which I personally am expecting? Then we want to look at this black line. So if there's a housing crash, kind of like what happened back in 08-09, that scenario puts us even lower. So it's if we start at the baseline, and then right here where everything forks, we follow that black line down, and it falls all the way down to just about 3,000. And again, but the key here is that the bottom is hitting right around July 2023. And then it has another V recovery, but it's not as steep. And so that shows it's slowly recovering so that we don't even get back up, not even to 4,000 until the end of 2024. So that's a potential scenario coming up if we have a housing problem. Okay, the next scenario is what if inflation is sticky, it says. Well, that to me says, what if inflation continues bad? What if inflation continues out of control? So that one we're looking at this brown line. And if inflation continues out of control like it is, then that scenario shows the markets going from where they are now, bottoming in July 2023, all the way down to 2,500 for the S&P. And then it shows us somewhat of a V recovery, getting back to not even 3,700 roughly, late 2024. So that would be a very slow recovery. So that wouldn't be good if inflation doesn't come down. And of course, that's why the Feds are continuing to add their rate increase, because they're trying to control inflation and get it to come back down. Okay, the last scenario here says rapid inflation fall, no recession. So what if inflation stops going up, reverses, goes down, and there's no recession? In that case, then the models are showing that it'd be this green line up above here. And that shows that we wouldn't even fall any further than we currently are. And it would just take off up to nearly 5,000, 4,700, it looks like, by the end of 2024. And which would be just as good for 2023. So I personally don't think that one's going to happen. I don't think inflation is going to fall, unfortunately. I think there could very well be a housing downturn. So I do believe that we're going to have a fall. And again, what we want to notice here is that all of these scenarios are bottoming right around July 2023. And that's the reason Zach and many others in my group are very bearish on the markets, even though we're having a little bull run pump. They don't believe it's sustainable at this point. And, you know, I kind of agree with him when I'm looking at these charts. I know it's easy to say, oh, yeah, I agree with him, but I really do. But I have to admit, I was very surprised to see this pump that we're having right now. I expected markets to fall quicker than they have, which is why I got out of my little short trades already, because I really expected the markets to fall. And they did a little bit, but then they surprised the hell out of me, and then they recovered again. So this is going to be interesting to watch this play out and see if we do indeed fall till July of 2023 of this year. But I'm being very cautious until that time. I'm not doing a lot of plays on anything. I want to see if we're bottoming out. And if we do bottom out in July, then I'll probably buy some more of something. Okay, let's move on. This next chart is showing what happened to the S&P 500 ETF Spider Trust, which is just a good overview to see what happened throughout from COVID until current. So pre-COVID was at this level here, which looks like it's right around 330. That was a line that's right. This line is right in the middle. The bottom line here shows a support at right around 300. So that was pre-COVID highs, was right around 360 roughly. And then for 2022, we can see that the S&P Spider Trust, which follows the S&P 500, I do believe, it just kept going down. First quarter started here. Second quarter is down. Third quarter is down. Fourth quarter is down. So I know Zach, like I said, is expecting this to continue to fall until middle of this year. And this chart just shows that that's the trend that we're on. Okay, so the TLDR on what we just talked about is there's a low growth environment. The global economy is projected to expand at a sluggish pace of around 1.6% in 2023 as financial conditions tighten. The winter aggravates China's COVID policy and Europe's natural gas problems persist. Number two, Q1 and Q2 will be a downhill ride, and that's what we've been seeing from all these charts so far. In the first half of 2023, the S&P is expected to retest the lows of 2022, but a pivot from the Fed could drive an asset recovery later in the year, pushing the S&P 500 back up towards 4,000 by the end of the year. Number three, inflation and interest rates peak. Inflation will start to moderate due to the slowing economy. The Fed will continue to raise interest rates at a much slower pace to 5 to 5.5%, and the peak in interest rates will provide support to financial markets. And that doesn't happen until halfway through the year. Improved risk reward. So there's potential for further downside is more limited than in 2022. So he's saying there's less potential for downside movement up until or after the middle of the year. The suppressed valuations will provide great risk reward opportunities. In other words, there's still a lot of value in the markets, but everything is suppressed right now because the macro environment looks so bad. And that fear tends to drive things down. So everybody is FOMOing down just like they can FOMO in. And FOMO, of course, is fear of missing out. All right, let's try the next slide because this is going to be kind of a long training today going through these. So now we're going to look briefly at TradFi. There's a couple of things in here. This says that despite setbacks, crypto is inevitable. And what he says here, and I 100% agree, is the innovations that have occurred from cryptocurrency and blockchain and distributed ledger technology cannot be undone. It cannot be uninvented. So there's a lot happening in the world with cryptocurrencies and with regular companies. We'll see in a couple of slides coming. There's a lot of companies getting on board. Just like we see Visa is on board with settlement for stable coins. I mean, I find that just amazing. Settlement volumes have been rivaling incumbents. Computing, Web3 computing protocols regarding decentralizing the internet are growing. They're just booming. So there's a lot happening. Let's go on to the next slide and see what he's got in this next one. So there are actually, oh, I think I might have skipped the TradFi. If I did, it was just, I had very little on it because we're now moving, I think we're moving into the crypto section. But anyway, so there's 18,416 monthly active developers in Web3 right now. And Web3 is what the blockchain is all about. That's a lot of developers. And you can see that from 2016 to current that they have been just on an uphill trajectory. Lots of developers moving into the space of crypto. So there are major brands that have been opening up NFT collections. I'm just finding it amazing how many of these have jumped on board. You know, we got the NBA, Taco Bell, Burger King, Starbucks, which many of us may know about from recently. Adidas, Puma, Nike is on board. There's just a lot of activity going on with NFTs. They seem to be driving the markets right now as far as interest goes. Here's one on crypto fundraising. So private market funding fell 77% during the second half of 2022, while the number of funded projects dropped by 56%. So even funding for crypto projects has definitely slowed way down. You know, the first half of 2022, there was $29.3 billion raised for funding new crypto projects. In the second half of 2022, that dropped all the way down to 6.6 billion. However, 6.6 billion is still a lot of money. There's still a lot of activity going on. So I'm still quite confident that we have not seen the end of crypto. And this slide just brings up some layer ones, upstart layer ones. So I thought you probably can't see them, but I'm just going to read them out loud here. And here's the ones that are protocols to watch for, it says. Aptos is one, SUI, SUI, SEI, SEI, I'm not sure how you pronounce these, Canto, CANTO, and OL networks. Apparently these are upstart layer ones. And of course, layer one is what Bitcoin is. Bitcoin's a layer one, Ethereum's a layer one, Litecoin's a layer one, Bitcoin Cash is a layer one, Dogecoin's a layer one. So, and a layer two would be, if anybody's heard of Arbitrum, that would be a layer two. All right, so let's move on and see what the next one is. This is Web3 gaming. So projects to look out for Web3 gaming. I've got STEPN, STPN, Immutable X, Axie, Stardust, Engine, ENJIN. I had made some money on Engine a while back. Sandbox, I made some money on that one a while back. Illuvium, Webaverse. So I'm surprised some of these are not new to me, like Sandbox, Engine, and Immutable X and Axie. Those are not new. Those have been around. Like I said, I made some money on them. But these are Web3 gaming projects that he says you want to pay attention to. Decentralized social. Now, this is fairly new, and I think some of these are very much worth checking out. So, you know, what does decentralized social mean? It's like putting, putting Twitter into a Web3 on the blockchain, or putting Signal on the blockchain, or putting, you know, any social project or social app right now that's in Web 2, which would be like, you know, Twitter and Facebook and all that. There's projects that are trying to duplicate that in Web 3 in the blockchain arena. So one of those is called Lens, Lens. We've got one called Farcaster, Orbis, DeSo. That's one I actually own a little bit of DeSo, DESO. CyberConnect, Ceramic, Lit, Lenster, Lenster. So there's some things for you to consider doing some research on. And the very last one I've never even heard of. I don't know what he means by DePIN. Let's see what it says. Decentralized physical infrastructure. I wonder if this is like IOTA, like the Internet of Things. That would be my guess. DePIN protocols incentivize hardware operators to provide critical decentralized services to apps. And I know Helium is one of the biggest ones. So here's some others that you want to check out. There's one called Pollen, Hivemapper, LivePeer, Filecoin's been around a long time, Airweave, RNDR, and Akash, AKASH. So that's kind of fun to have some things to look forward to. So here's Bitcoin, a chart of Bitcoin against the U.S. dollar, and he's showing that he believes it's bottoming out around, or it did bottom out at around 13,723, and of course we're now up around 2,300. And perhaps this chart is really what he meant to say is that's where he believes it will bottom out, because we haven't gotten down to 13,000 just yet. I think the lowest was, I don't know, 15 or 16,000, I think, recently. So this is maybe what he's looking for in July. So it'll be really interesting to see if we go from current pricing, which I think is pretty close to 23,000, down to 13,000. That'll be a bit of a shock to the market if we do. So here's a quick TLDR on the crypto thesis, which is we are early, but there's a lot of innovation still happening. 100% agree with that. Web3 is becoming more user-friendly. Slowly but surely, it needs to become more user-friendly, in my opinion. Number 3 says new layer ones, Web3 gaming, decentralized social, and DePIN are going to be the hottest segments coming in the new year. Number 4, major brands will continue to integrate, and this is going to help drive interest in crypto by having major brands that we all know starting to integrate crypto into their products and services. So that is all I have today. I hope that was somewhat helpful, a bit of an impromptu training, like I said. I apologize for not having time to really put my own thing together, which I very much enjoy doing. But I really enjoyed seeing what Zach thinks about the markets. And since I'm part of the group, I already knew that he believes that we're going down more towards the middle of the year. And it's going to be interesting to see if it plays out that way. So I'm very cautious right now with what I'm doing, because if it does fall, I want to be ready for it, because that means we'll want to start buying in at towards the bottom, which may be around June or July. So as always, give me a thumbs up or a 1 in the comments if you like the training. I see there's a comment here. Do you feel the Ukraine-Russia conflict could bottom the market? I think my personal opinion is if the Ukraine-Russia conflict were to come to an end, that the markets will go up from there. I think taking that geopolitical risk off the table will help dramatically. I think it's helping the markets get to the bottom because of what's going on over there. But I'm not a macroeconomics person. I do pay attention to it because I have friends that in all of my groups that follow it more than I do, so I get to piggyback off of what they know. And nobody has a crystal ball, but I'm confident that war is coming closer and closer to an end. And when it does, the markets are going to have a little bit more breathing room. But the Fed fund rate continuing to go up through May, June of this year is going to keep a lid on the markets, in my opinion, and we're not going to see a lot of good movement until after that. So I hope that was somewhat helpful. I look forward to talking to you guys again next Monday, and I'll have some other great posts for you in Facebook, so please stay tuned. Take care.